All right, so I'm gonna go over basically my personal strategy that I use. Um I was taught a little different way to trade, but I kind of just came up, noticed things in the market that obviously manipulation and smart money concepts shows a lot about market structure, but it fails to really recognize what's happening, and it's just manipulation that's moving the market. And it happens every day on all time frames. And one way that really helps me identify these areas of manipulation is looking for whatever time frame you're on, looking for relatively equal highs. So as you can see here, and I'll show you just how this happens on every single time frame. But obviously, the bigger the time frame, the bigger the opportunity. As you can see here, over 1,000 pips on gold. Very high risk reward trade because it is one of those higher time frame setups. But you can get the same type of high risk reward trade using this strategy on any time frame. And I'll show you how that works. So as you can see here, we have a gold on a daily time frame. I don't really need to go any higher in time frame just because I can already see here are relatively equal highs. And that is the first thing you're going to look for, is that liquidity, that liquidity to get swept. It's very obvious. These things, it looks like it's hard to really identify, but my eyes are trained to really point these things out because I've been looking at them for a long time now, and I can see equal highs. So you would, on your chart, trading in real time, would only see here. So what we would be looking at here is our equal highs, and this is what we would just be waiting for. And if we go one more, boom, do that. Let's just go back here. And we have our institutional candle on a daily. Now, this is important because now we've just been waiting here for our liquidity, and now we actually are in play because we have some manipulation and we're ready to see the market make a big swing, because we're here on a daily, right? Now, what I'm going to do is, now the strategy is very simple. I'm going to keep it simple here on this daily time frame just to show you how simple it is. Simple liquidity, institutional candle. And this is where candlestick play comes into play and being very important in terms of price action, because this strategy, you shouldn't need to use any indicators, you shouldn't need to use any Fibonacci tools, strictly price action. I can use this. As you can see here, when you see this manipulation happen, your stop loss is going to go right above the high of this wick. And you're not going to enter until we start to see price reverse against this here buy side liquidity. So what's happening here is we expect this liquidity to get run aggressively and reverse itself down the opposite way. See? Boom. Almost instantaneously goes down. So right here, when we have that pressure, now we know we're going to the downside. And as soon as you have any bearish candle close below that last bullish candle up, is anywhere you can get in. So about the end of that candle here is where we want to get in. So we're looking at stop loss there, entry here, and let's see what happens. Get that. Wouldn't even had to trade all this here because you were already in the trade, catching that over 1,000 pips, high risk reward trade. So this is on here on a daily. As you can see, this is a swing trade. So you would hold this trade for a long time, but that's no one's catching this amount of pips in that amount of time consistently. So this is how you really swing trade and hold trades for a long time. But we can do this, like I said, this happens on any time frame. Very simple strategy. It's going to happen over and over again, and you're going to get used to it the more and more you see it. Okay, so now let's go back to present time, so we can look at smaller time frames, how this is happening. As I can see, we can go back as far as July 25th. You know, you're gonna have these ranges here. Now we're looking at gold on hourly. So the first we see here, gold kind of just comes into this range and consolidates. So we're stuck in this here consolidation. But I don't really see it as consolidation. I just see it as a range that needs to be broken. But what the market likes to do is it likes to play around a lot, as we can see here. Here we have our range. Here we have our range, to be more precise. And you're just going to look for these ranges of liquidity and simply just wait. And the key to this is patient, waiting for that liquidity to get swept, because it will be very subtle, but it will be the same pattern, repeats itself. As you can see here, we have their equal lows. Sell side liquidity swept. And as soon as we see that, we're going to anticipate quick reversal aggressively to the upside. And one way we're going to do that is, like I said, no indicators, no nothing. I don't even need this. Indicators. But timing is important. As we can see here, we around market open 10 o'clock is when we see this move. So what you would do is, as soon as you see this manipulation happen, if I drop down to 15-minute, we're going to mark the area that actually swept liquidity, which would be this candle. And as soon as we have price action move away from this last bearish candle that swept liquidity, and we have a bullish candle close above the last open of that bearish candle. So basically, this candle closing bullish over top of this bearish candle opening bearish. So this is where we would want to enter our trade at this point. And our stop loss is going to go right below the wick of that institutional candle. As you can see here, price just expands, and you're looking at yeah, 742 pips on gold in a matter of 5 days. Now, what kind of risk reward is that? 1 to 11. That's just off one trade, and you have all your smart money concept ICT trader guys who are gonna just, get in all this noise, which is fine, but as you can see, you're gonna just be dealing with a lot of mess as far as getting your right entry in, because the market's gonna continue to retrace and sweep this liquidity. So if you are not trading getting your right entries, you can easily be taken out with a lot of manipulation that's occurring in this internal liquidity. So that is why a lot of traders fell. They're getting caught up smaller time frame liquidity and not really looking at the bigger picture and seeing really what's happening here, because you're not meant to take every single trade, every single point. Yeah, it's supposed to be at certain points, where the market is moving rapidly away from these order blocks. So as you can see here, this happens on an order block, and that is why price is moving so aggressively, because this is a key level when it comes to orders. Price came here, moved rapidly away. Price came here, moved rapidly away. And this only occurs in areas that are, key levels. So yeah, just to show you, this happens not all the time. That's why impatient is so important, because you have to wait for these opportunities to really present themselves, but they can be found on all time frames if you really take the time to look in. So I'm going to show you a couple more. Now the markets are fractal, so we'll often see this scattered throughout multiple different time frames. As we can see here, we have a range inside of a range, right? Because this is where confluence comes into play, and this is a great example of us showing us confluence, because what we're working with is the overall picture being our expansion, retracement, and expansion again. So that is the bigger picture of what is happening here, but we have to take a closer look at what's going on, because the algorithms are generating liquidity, manipulating the market. So it's really important to understand where you are, but the basis, the blueprint for understanding this and making it all make sense is understanding what is happening, and that is traps being set, equal highs, relatively equal highs, which your eyes will begin to learn. Traps being set around these areas where a lot of stop losses are resting, liquidity is going to get swept. So I can see this relatively equal highs here, and also I can see the aggressive manipulative move up to the upside. And once I see that, I can look down here on a smaller 5-minute, and you can see the market structure having a changing character. So now structure is broken, retests. As I mentioned, just using price action and market structure, you should be able to accurately enter this trade right off of this here support and resistance level where the market returns, because it's going to create this here new range after breaking structure, retrace. That is where your entry will be, with stop losses resting right above that last area of liquidity. As we can see here, the entry here would have gotten a risk reward of 9.42 with a re-entry of 5.16. And as you can see here, even on the re-entries, it's doing the same thing, just on a smaller time frame. And this is why the markets are fractal. So after we see the bigger time frame shift, now we're seeing this same thing kind of play out here in smaller time frames. Liquidity here, institutional candle, close, bearish candle closing below the candle that took liquidity. And then having a nice little small scalp to the downside and taking profit where this area of liquidity is. So that would have been a nice small time frame scalp. But if you wanted to get another entry, as you can see here, the same thing happens. So now, remember, markets being fractal, this liquidity being run, now it's creating this liquidity. So you have another area of liquidity, the range inside of the range being swept here with this institutional candle before the actual move being made here. So manipulative move to the upside, sweeping liquidity, bearish candle close below the last bullish candle that swept liquidity. And actually on a 5-minute, we can be a lot more precise. So as we can see, just so you can see what I mean by price action will be enough to get you accurate entry. The last bullish candle that swept liquidity is here. So any bearish candle that closes below the open of this candle is good for entry. And right here would suffice just because a lot of volume is picking up. So I would enter my trade somewhere around here, but maybe to be more safe, probably around here. So now you have 32 pip stop with 120 pips. So a nice 3-to-7 risk reward ratio. And remember, this is just all part of the longer move. So here you can be taking partials while holding your longer confluence trade, taking partials as market begins to sweep liquidity. So to see here, as liquidity here to the left gets taken, we can close out our orders and take profit because market is going to continue to make its way down. So we won't have to get back in the market and take more risk. And there's plenty of opportunities to get in. So you can see here, it can get more complex because, as I said, there will be times where we have ranges inside ranges and the market is, just playing around. As you can see here, we have our relatively equal highs in here. This liquidity. And we have our institutional move that is run above that liquidity. And as soon as we have our bearish candle close below that last move that swept liquidity, which would be here, because as you can see, very subtly does it close below, but this would be a good area to get in. You would catch this move to the downside, but as you can see, you would be able to take profit here where this liquidity rests. So the trade would look something like this. Nice 1.84 risk reward, 1 to 2 risk reward. But you don't want to trade all these small, tiny time frames. You want to stick to the bigger move. So, recognize this as internal liquidity. So if you really wanted to, you could, but you want to kind of recognize this as here internal liquidity. And this more of the external liquidity inside that range. So once these ranges get run, we'll see the actual move. And so if we just take away this and focus on this range, now what we're looking at is the liquidity sweeping these relatively highs before reversing to the downside. And I would actually have to go down to 1 minute just to get this entry, because it's very rapid. So market's going to manipulate both sides of the market. So as you can see here, the initial liquidity sweep went to the downside, and you'll see this pattern happen a lot. I've recognized it. The side that usually gets, when there's two liquidity sweeps, like a double-edged, the side that gets swept first is usually the intended direction it will go. Maybe not all the time, but most of the time I've tested this, it goes to the initial liquidity sweep that gets run aggressively, not something small like this. I'm talking about the aggressive moves, long, aggressive, manipulative moves. This. So when you see two of these, one being there and one being here that way, expect it to go in the original direction, because this is how they're taking out buyers and sellers on both sides of the market. You're going to sweep all the sell side liquidity, sweep all the buy side liquidity, just to go in the original intended direction, which would have been the breakout retest to the downside. But it's capturing liquidity and manipulating the market. So this is how to have an edge in the traders that are manipulating the market and be in the trades at the same time. So as you can see, if we went with the bigger move, so once we saw this liquidity swept, we're automatically shifting our bias to go long. So an entry on this would have looked like this. Marked out our institutional candle that ran below liquidity. And as soon as we got our bearish candle close above that open of that bearish candle, so our close of that bullish candle here, would go ahead and enter there. And now we have, boom, a nice quick 1 to 2.3 risk reward for a counter trend trade. But this is not something I did not advise to counter trend trade. I would simply prefer to recognize that this is the initial direction that it's going to go, and simply wait for price to return and focus on taking the sell. So as you can see here, waited till a little bit after market open, and usually around 10:30 to 11 time is where we get the initial move, the actual move. So being patient is the name of the game here, and waiting to see this price action. So I can see price get run clean above liquidity and immediately reverse to the downside. And again, strictly using price action to get these entries. So we're going to put our stop above that high. And as soon as we get that candle close below, that bearish candle close below that bullish move, which is right here, we can go ahead and mark our entries. And this gave us nice 182 pips to the downside that went actually, if you held it like 320 pips, but we would have taken it there. Okay. So yeah, so that's basically, where we're at right now, in terms of gold. And I can do another video is just to show that not only does this happen on every time frame, um, it also happens on every pair, every asset. It may have their own nuances and things like that, but for the most part, it's very simple. And obviously adding, other concepts and other confidences into this is only gonna make your probability even higher, but you want to really focus on the bigger time frame and that confluence, because as you can see here, that's where the real return relies. Yeah, so I hope you enjoyed that, and definitely put this into practice, test it out, back test, and get used to applying these and using risk management. Take care.